Hello, welcome to Born Investor. In today's video, we will be going to learn about the following. What are circuit filters? How circuit filter works. So let us start. Sometimes share prices tend to move rapidly in a direction, either up or down. This can create sudden panic in the mind of investors and can lead them to a huge loss. To prevent these losses, circuit filters were introduced. The circuit filter is a price band levied by SEBI to stop large price movement in a stock. This price band comes with a lower price called as the lower circuit and the upper price called as the upper circuit. The stock price cannot move beyond these prices in a single day. Once a certain stock hits the circuit, no more buy sell orders can be placed. You can only modify or cancel existing orders. In India, we only have a circuit limit of 2%, 5%, 10%, and 20%, and it is decided by the exchange that how much limit will be there on which stock. Suppose there is a limit of 5% on a certain stock. This means that the stock can only move 5% of the price on which it previously closed, either upwards or downwards. For example, suppose there is a stock A which has a circuit limit of 5% and the price at which it closed yesterday was rupees 100. It can only move 5% of rupees 100, that is 5 rupees upwards or downwards in a single day. Now assume that the price hits 105, that is the upper limit. Trading will be stopped on stock A for the day. In this case, 95 to 105 is the range in which stock A can move. This is known as the price band. However, there is an exception that comes into point here. Those stocks which are present in the F&O segment don't have any circuit limit on them. They can move as much as they want in a single day.